That is correct in a time when the investment alternatives for the equity side are relatively poor to non-existing. And I wonder what may happen when that changes. So let's assume that the general interest situation will go up by 200 basis points. You made the comment half an hour ago whether the risk premium on real estate will go the same way. That is an interesting question. If that is not the case, I assume that the banking side will not provide financing at an LTV at least above 70%, rather below that. And then the question is, if that is the case, if there is sufficient liquidity on the lending side in the market, which I assume will come from different sources than the banking side, so from new CMBS lendings, which you already see. We call it platform financing because it is not the same CMBS style. We are involved in these, and we see it developing because when you speak to the initiators, they foresee exactly that situation. Currently, to do it with a lot of equity is simple because the alternative of high-yielding investments is simply not there. When it changes, I'm not sure that the lending side, the banks, are able to supply enough funding to replace the equity. So I assume new sources would come into the market.
Well, I think your statement is right concerning LTVs in excess of 70%.
Yeah.
The statement I made was related to, let's say, a standard financing in Germany between, let's say, 55 to 70%. For this range of risk, I think the banking market is very liquid. For the risk, anything beyond 70%, the lending market is still very dry. This is true and will require the engagement of, let's say, alternative debt providers. But at the moment, as most of the investors are prudent core and long-term investors, and as Kai already stated, usually bring a lot of equity, at least 25 or 30%, sometimes even 40 or 50%, for those type of investors, the lending market is absolutely liquid. This is what I wanted to say.
And competitive.
And competitive, yes.